Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on a Thursday afternoon, and quite excited to be joined by Jorge Ganoza of Fortuna Mining, who had their fourth quarter and also full year 2024 earnings out late last night and ahead of this morning's session. So earnings did include a record of $95.6 million in free cash flow. So certainly will be plenty to talk about. And maybe later on towards the end, we'll dig into looking at the fourth quarter gold price and then where we've been at for the first quarter as well. But also joining us, of course, is Dave Kranzler. So Dave of Investment Research Dynamics, our mining analyst in-house here. And gentlemen, great to have you both on here. And Jorge, I'll turn it over to you first, and I will pull up the news in the background here. But certainly, exciting quarter, and perhaps you could recap the results that you came back with for everyone watching at home.
Thank you, Chris, and good to see you, Dave, there. We reported our year-end results. They have been taken positively by the market. And basically, what we have been able to show is a track record of expanding margins, while as an outcome of what? Of higher gold prices, continued rising prices, and being able to keep our cost steady. No, I think a big demand from the investors community is okay. Prices are rising, but show me that you can expand your margins, and all of that is not eaten away by cost creep or those things, right? So we had several landmarks in our financial reporting. First is the first time for a year that we record sales of over $1 billion, $1.1 billion in sales for 2024. As you well mentioned, we had for the quarter record free cash flow. Or net cash from operations before working capital adjustments was a strong $141 million. But what's important here is that quarter over quarter, the margin on cash from operations grew from 33% to 50%. No? And that's on the back of us selling in the quarter at a gold price that was 7% higher than the previous quarter. That was $2,660, the average price for gold we realized in the fourth quarter. So with that price, we expanded our margins from 33 to 50%. How? Capturing the opportunities of prices and keeping our cost and capital under control, right? So I think the market is rewarding us today because we're showing that we can fully capture the benefit of increased prices, right?
Okay, and I might add that the record free cash flow comes on the heels of the previous quarter where you had record attributable earnings. And we actually did have a question from an investor if you could explain the difference between the earnings and the attributable earnings. And then perhaps from there, obviously, we have the share buybacks, which was a significant amount. But
yeah, it's very simple. On the particularly applicable to our West African business, our mines are not 100% owned. Our partner is the different states, the state of Burkina Faso, the state of Cote d'Ivoire. They own 10%. No, so the attributable, earnings is what's attributable to Fortuna, right? So that consolidates all of our attributable earnings and adjusted earnings. And this only applies to our mines in West Africa, where the state is our 10% partner. Yeah, that's for the difference between attributable and not attributable. What was the other question?
Well, A, thank you for that. I think that will be a helpful explanation for people. And B, obviously, in these calls that we've been doing, you in particular have talked plenty about the focus on capital allocation. And we did talk about this a little bit previously, but we'll mention again that you returned 30.6 million to shareholders through the share buybacks, which came out at 6.4 million shares. And also note to hear that you have continued doing that in January. So would love to hear anything you could add on that.
To talk about return to shareholders, let me step back for a second and talk about 4 priorities we set for ourselves back in 2023 as we were coming out of the Séguéla construction in mid-2023. So we set for ourselves 4 priorities. First, put in place a fortress balance sheet, right? We had been investing heavily on the expansion to West Africa, on the construction of Séguéla, our flagship asset. Coming out of that, we said, let's first put back together a fortress balance sheet. Second, we identify a lot of opportunities within our portfolio, and it will require capital to unlock the value that we have in the properties we already own. So let's make sure we're investing smartly and aggressively in our property portfolio to unlock all of that value. Third, let's be with that achieving the strength in the balance sheet, then we can start thinking about return to shareholders, right? And that becomes topical for us moving forward. And last is we'll always remain alert to acquisition opportunities. And but for that, we need to the first priority is put together a fortress balance sheet, and we have achieved that, right? So we can talk about our balance sheet. We can talk about the strength of our cash position, or liquidity, or low debt leverage. But we have achieved that. And now, so the first thing we have taken opportunity to do is provide aggressive returns to our shareholders. So in the fourth quarter, we were aggressive in the share repurchase program, $30 million. And in January of this year, we were active in the market again. We repurchased about $1.8 million, or 400,000 shares. And then we had the blackouts for the reporting quarter that we just reported today, right? So we've been on a blackout since late January, early February. So, I think particularly at current valuation levels, we see a lot of value in being active in the market, repurchasing our shares.
Okay. Certainly interesting timing where obviously you were in a different position as you were building the mine over the past couple of years, but now to have a balance sheet that you like where you're in that position, especially while we have the elevated gold price and still a depressed project market out there, which perhaps a little later we'll dig into that a little bit more and any thoughts you might have on approaching that. But Dave, I will hand it over to you. I won't even ask your favorite question first. I'll let you have the chance to do that. Although perhaps you could start anything on your list specifically related to the earnings, and then we can take it from there.
I mean, to me, the earnings were pretty straightforward. So I kind of had more questions specifically about the operations going forward, and well, the current question about Séguéla. So not well, I guess this does relate to earnings. If you stripped San Jose out of the cost side of the equation, do you know what the all-in sustaining cost would have been for 2024? And then what do you expect it to be for 2025?
Yes, we can adjust for that. Or 2024 AISC was $1,640 for the year, and adjusting for San Jose, it travels at around $1,500, right? What's $1,500? The global gold mining industry, I mean, 50% of global gold mine production today is produced at $1,500 or better. So $1,500, let's call it the median, is a good place to be, and strategically is where we want to be, right? So, as you know, San Jose by now has been placed on care and maintenance, and it's under a sale process. And it one takes away our highest cost asset. It brings our consolidated cost down naturally, and also helps us focus management time and capital in high value opportunities within the portfolio. No? So we're working on that.
And un momento, David. Jorge, can you talk about the timeline of when you expect to close it, and would it be the closing when you would see that adjustment impact the cost?
Yeah, no, the mine has been placed on care and maintenance already, so we're not gonna see those ounces weighing on cost anymore.
Okay.
Or care and maintenance cost moving forward is around $400,000 a month or so. Yeah, in that range. But the sale process is ongoing, and yeah, we're advancing, but hopefully we'll have something to announce during this month of March.
Okay. Dave?
So your 2026 guidance for Séguéla is 160 to 180,000 ounces.
Sure.
I mean, how the heck are you guys achieving this increase in production over nameplate? I mean, it's incredible.
Yes, we are, as I explained in the past, anytime you build a facility like a processing plant we have in Séguéla, in the design you incorporate flexibility, because we're dealing with estimates, right? Rock hardness, residence time in the tanks, in the thickeners, and all of that good stuff. So you build some wiggle room in every aspect of the design, and it's rare when you get to capture all of those opportunities, no? At Séguéla, we have captured all of those opportunities, and that what has allowed us to push the capacity at 38-40% above nameplate capacity without any significant investment, right? So with that, we are unlocking the opportunity to produce more gold every year. And we have provided guidance at that mine, not only for 2025, which is around 140,000 ounces of gold, but we are showing that for 2026, as you mentioned, Dave, we can take the mine to between 160 and 180,000 ounces. But more importantly, at industry-leading cost. We just talked about that the median for the industry today is around $1,500. And what we're saying is that in 2026, we can produce at around 12 to 1,350, right? That's the guidance we have provided. So that mine is going to be a cash cow. It's a high-grade mine. And yeah, it's looking very good. It's looking very strong. Yeah.
I mean, do you have any notion of where the ceiling is on the facility on the physical side of the facility as it is now?
I believe we're there. I honestly believe we're there. The plan, to put it in figures, was designed the nameplate was for 1.2 million tons milled and processed every year. And for 2025, we're budgeting already 1.7 million tons per year.
It's incredible.
So we believe that there we're already reaching the bounds of the infrastructure we have in place. And to go beyond that will likely require some changes and additions. For example, a regrind mill, perhaps, certainly more thickening and leaching tanks, no? Things like that. Another thing that perhaps is important to mention is that there is no free lunch. So if we want to produce 160 and 180,000 ounces of gold in 2026, there are some investments that we'll have to advance because we're producing at a higher throughput rate. So in 2025, our AISC at that one mine is going to be at around $1,300-$1,500. Why? Because we have to prepare the mine for more throughput on the ancillary infrastructure. What do I mean? For example, the tailings facility. We need to expand the tailings facility that has a budget of close to $6-8 million this year, right? We need to access our deposits because we're mining at a higher throughput rate. So to access those deposits, we need to build roads and start stripping and things like that sooner, right? So all of that expansion is taking place. So in 2025, we're seeing a bit of an elevated AISC, still very competitive on global terms, no? But we have a bit of a hump. It goes to around $1,500 per ounce, and then it comes back again down in 2026 when we really start producing the additional ounces, right?
Dave, just real quick before your next question, just want to give context to people who are watching at home that when Jorge was mentioning the 160 to 180,000 ounce range in 2026, that is compared to the 2024 total, which was almost 138,000 ounces. So just so people can have the context of what kind of increase we're looking at. And Dave, you can take it away again.
I told you I wouldn't bother you about Diamba Sud this time. So, but I will say I'm looking forward to eventually attending the first gold pour.
You're putting pressure on us.
Actually, I was wondering if you could discuss, because I think I can't remember I think you might have mentioned it, or one of your management guys mentioned it on the earnings call. Can you discuss the opportunities that you see at the Tongon North prospect in Côte d'Ivoire, and also the Arizaro gold porphyry system that's at Lindero?
Yes, Tongon is a prospect that we have in the portfolio. It's a joint venture option agreement, and it's not something we've been talking about up until now. It is a large land package in the north of Côte d'Ivoire, north of Séguéla. And what we have there is a large land package on the right rocks, on the right, Birimian greenstone rocks that are so productive throughout West Africa, with the right structures, with the right geochemistry, and has not been drill tested. So we optioned the property. We like it very much, and we have initiated this year a 10,000-meter drill program. And we're I would say 20% advanced with that. It's very early stage, but we're getting some consistent visuals and some early numbers that give room to encourage. And that's why we're happy to start talking about it. And pay attention to our news releases, because we will start talking more and more about Tongon as we continue advancing. We're currently funding a 10,000-meter drill program, which is sizable for a first pass on a property like this.
Just quickly, is that on the same trend as Séguéla?
I wouldn't use the word trend for this particular case. It's driving time from Séguéla is probably 6 hours north, 6 to 8 hours due north. It's close to the border with Burkina Faso. And it's a very productive area, some large deposits there. Barrick has one of its old Randgold mines there. It's called the Tongon mine. And our property is some kilometers away, 10, 20 kilometers away from the Tongon mine. And we're drilling away, and the project is advancing well. So we look forward to updating the market with our results. And with respect to the Arizaro porphyry in Lindero, the Lindero gold discovery was made 25 years ago, right? And the gold discovery at Lindero was not made at Lindero. It was made at Arizaro. Arizaro, within the property, we have two large porphyries. One is the Lindero porphyry, and the other one is the Arizaro porphyry. Gold was first discovered at Arizaro, but then quickly work shifted to the Lindero porphyry, which is only 3 kilometers away, because at Lindero, they started identifying high-grade gold that's about 1 gram gold on surface. So they forgot completely about Arizaro and moved to Lindero. So the Arizaro porphyry has never been properly explored, no? And it's only now that we're doing comprehensive work trying to understand the porphyry. The porphyry was never systematically sampled, no? And we're doing all of that systematic work. We have identified anomalies, and drilling is starting this month of March. Anything we discover there will be trucked to Lindero. It's only 3 kilometers away, within our property, within our surface rights. No? So the threshold to make anything we discover there economic is very low, right? We'll use the existing infrastructure we have at Lindero. Now, remind you that Lindero has almost a decade in reserves today, right? So it's not like we're pressed by a short life of mine, but it's work that we want to advance this year. And as I go back to my original statement at the beginning of the conversation, when I talked about our priorities, fortress balance sheet, invest in the portfolio, unlock the value we have in the portfolio, return to shareholders and their money. No?
Just real quickly as a follow-up, and then I'm done. Let's just sort of talk in the theoretical here. Let's say you end up at Arizaro with something that looks similar to the Lindero deposit. Would you, at that point, would you just use that to extend the mine life, or would you look to possibly increase the production at Lindero?
It will depend on what we find.
Sure, but just theoretically.
Theoretically, can we expand the Lindero infrastructure? Yes. Yes, we can. What will drive if we expand or not resides on how big, how rich is what we discover, right? It's something that small will likely just go to the tail end of the reserves, to be mined in 2035, 36. Or if it's something a bit more meaningful, more higher grade, we'll do our best to try to bring it forward, right?
That's it for me.
That's it, Dave.
Thank you.
Okay. Well, if you think of any other ones, you just let me know and we'll get you back in there. Jorge, one thing I thought would be helpful for people to hear is that you mentioned in the press release the earnings of fourth quarter were impacted by 26.3 million of non-cash charges. Perhaps you could just let people know the important parts of what they need to know there, and if there's any impact going forward on any of these.
Yes, we have taken some non-cash charges. And in this business, we explore, we allocate capital to exploration in new properties. In this case, the Bosura property in Burkina Faso. And a time when you decide that the property does not merit more work, you take an impairment. No, you discount it from the value of your earnings. So that is what has happened in the case of Bosura. No, so we also have taken a non-cash charge on some stockpiles we have at Lindero, but that does not mean that those stockpiles are not going to be mined. Those stockpiles had a value, based on a price estimate and a cost estimate, and that has been adjusted, right? It's still economic and will for sure, absolutely, yes, run those stockpiles. But how we carry the value of those stockpiles in our books is just adjusted, right? So those are non-cash charges that take place. And that's why we make adjustments in a business that's so capital intensive. That's why I think it's relevant to watch us at the adjusted earnings. But even the adjusted earnings are impacted by some non-cash charges as well, or unrealized charges. For example, in our adjusted earnings, we're carrying the effect of the euro devaluation against the dollar because we have a recoverable VAT, taxes are still payable. That when in West Africa, which are euro marked, and when you have changes in or volatility in the exchange rate with the dollar, it goes against you or in favor, right? In this quarter, we had those charges against. So I think yes, absolutely, we need to look at earnings. But I tend to gravitate in a business like mining, in a business like us, gravitate a bit more towards cash flow, free cash flow measures.
Okay.
Real quickly, it said at the end there that the 7.2 million at Séguéla unwinds at closing. That essentially that means you'll add that 7.2 back to earnings, even though I know it's non-cash.
That's for San Jose, the 7 million.
San Jose.
Yes, at 7, we have done, or we carried a closure cost in our books. And after doing a study, that closure cost increased. So we have to increase that closure cost, and it is a non-cash charge in our earnings. And that will be, once the sale is materialized, reverted, right? Accounting. Yeah.
Okay. That answer your question there, Dave?
It did.
Okay. Jorge, the next thing I wanted to run by you, you mentioned that one of the reasons costs were a little higher at Séguéla is that you had lower head grades. I was wondering, just based on what you're seeing of the mining sequence, if there's any guidance you can offer of what we may be looking at 2025 or as far out as it's reasonable to comment on?
Our costs were very much in line with what we expected and very much within guidance. The only thing that we have advanced that impacts our all-in sustaining cost is what I explained, which is this infrastructure, for example, tailings. If we did not expand the mine, we were good for tailings with the facility we have. But we are all happy because we've been able to expand the mine and expand the processing capacity of the plant with very little investment. Well, but now that means that we're processing more ore and the tailings facility is going to fill faster. So we need to invest to expand that, right? And that weighs in our 2024 all-in sustaining cost, right? So there is no free lunch, right? Yes, we didn't have to install another mill or more tanks in the plant to achieve this successful expansion, but there are ancillary facilities like the tailings facility that needs to be expanded to accommodate the higher deposition of tailings, right? Higher rate of deposition of tailings.
Okay. And the next one I had here, yes, you mentioned, or it was not you, but one of the other gentlemen who spoke on your call this afternoon talked about you've had some success in extending the line of life at Yaramoko now into 2026, and anything you could share about that, I think people would love to hear.
Yes, we've been successful throughout 2024 in our exploration in the Zone 55 deep. We're almost a kilometer below surface mining. And by extending our underground development, we've been able to gain make quiet gains, I say, of ounces throughout the year. And at the end, we have provided for not just a very strong 2025, but mining operations that will continue into 2026, right? Remember, as I always say, that when we acquired Roxgold in 2021, Yaramoko was set for closure in 2023, and we didn't close the mine in 2023. Far from that, we had a very strong 2023. We have had a strong 2024. We're going to have a strong 2025, and now the mine continues until 2026 on the back of exploration success. Now, the Yaramoko mine all-in sustaining cost is for the year around $1,300, $1,300 and change. Very low cost. But that is, even though it's low cost, it's a bit higher than our guidance. Why? Because when we discovered all of this ore, well, we had to advance development to develop it and bring it into our mine plan. So we had to invest additional $9 million throughout 2024 to bring that new ore into our mine plans for 2025, right? There is no free lunch. So that is what we're seeing, and that's why our AISC at Yaramoko is a bit elevated, marginally elevated compared to what we guided, because we brought more ore. So the cost stayed competitive, but we had to invest a bit more capital, which is reflected in the all-in sustaining cost fee. But still, the costs are very competitive at that mine. We're mining 8 grams, 7 grams gold, and the mine produces comfortably in the range of $1,300 and change, right?
Yeah, and that was my next question. Every indication is that it's going to be similar grades going forward, which certainly has been quite nice at that mine.
Yes, we continue seeing grades. You know, it's a big nugget, we say, in our business. No, we have variability, but it's a mine that produces comfortably between 6 and 8 grams gold. Sometimes we're mining half an ounce, 15 grams, 14 grams, right? But on average, we're feeding the mill anywhere between 6 and 8 grams, depending what quarter we're in.
You better be careful mentioning that 15 grams. You might have a mining analyst from Denver snooping around soon enough. Although our next question, actually, you guys talked a little bit about this before we started, and I think you might want to comment on it because Navoff in the chat who's watching today, he mentions Fortuna stock could do 300%, and I would still believe for it to be fair value on a price to free cash flow basis. And a CIBC analyst is downgrading. What am I missing? And any thoughts from either of you on that one?
Yes, I have an opinion about the CIBC downgrade. You know, the CIBC analyst has downgraded Fortuna on 2 accounts. The first one is that it took the poor fellow a year to realize that our silver production has come down. My God, we changed the name of the company a year ago. We provide guidance every year, and this fool, it has taken him a year to realize that we're not a silver company. I mean, I changed the name of the company from Fortuna Silver Mines to Fortuna a year ago. I mean, what else do you want me to do? And it has taken the analyst that covers the company a year to figure that one out. So I have a serious pending conversation with that gentleman. So he also presents that we are a West African focused company and we should be compared with that West African producers. And he, in his note, tells us that Fortuna should be compared with companies like Orezone or Allied Gold. Hey, listen,
What?
I know those companies well. I know the management of the companies. We can all have an opinion on everybody, but those 2 guys I respect, right? Paddy Downey, the CEO of Orezone, is an ingenious engineer and lots of energy and doing good work at advancing his Bambore deposit in Orezone in Burkina Faso. And Peter Maroon is a person who has a track record of success with Allied Gold. But there is no way in hell that you can compare the valuations of Orson with its single asset in Burkina Faso and Fortuna with its diversified asset base. Burkina Faso today, and we're not shy to say it, is a very risky jurisdiction. 9% of our NAV, the Yaramoko mine, is in Burkina Faso. So how are you going to compare Orson's multiples, PNAV, to Fortuna's? You know, if you want to contend that Burkina Faso is the same as the Ivory Coast or Senegal, where we are based, that means that you are confused and you don't know West Africa, right? And that is what Mr. Analyst from CIBC is proposing, that we compare ourselves with Orson, a single asset company with its asset in one of the most risky jurisdictions in West Africa. And the same thing with Allied Gold. Allied Gold has assets in Mali, where Barrick just had 4 executives in jail for months, and the CEO of Resolute was placed in jail, and has an asset in Ethiopia and assets in Cote d'Ivoire. So a big portion of the value of Allied today is in risky Mali and unproven Ethiopia. So you cannot compare the multiples that you should be willing to assign to those two companies with Fortuna, with assets in Peru, with assets in Argentina, with assets in Cote d'Ivoire, with assets in Burkina Faso and Senegal. So I think that's just a bit ignorant, to be honest, and I'm not going to sugarcoat this. I think it's just ignorance, right? Yeah. So what are you missing? What is the person who is asking? What am I missing? Yeah, I don't know. I mean, if you want to assign Fortuna the same PNAV as a price to NAV as a multiple, as a company that has one single asset in Burkina Faso, it's up to you, my friend, right?
Yeah, well, if you do get in touch with him and he wants to come on and talk about it, feel free to invite him. And I can't promise I can keep my pit bull Dave in check, but Dave, I imagine you have something to say about that.
You know.
Oh, I went to town on that in the last issue of the Mining Stock Journal.
Yeah. So, that's how I view that. And, we're talking about or record free cash flow and whatnot. And I think investors should sit and reflect, on today, the free cash flow yield in Fortuna is over 16, 20% free cash flow yield. So the question is, how do you as an investor see that, the sustainability of that, right? And what multiple do you want to assign to our cash flow? Right now, we're being discounted, in part thanks to in a market that's very emotional, and volatile. I think there has been a reaction to the CIBC note, absolutely. But I think it's more of a knee-jerk than any real fundamental analysis. The other analysts, and I have to say, we're covered by the largest Canadian banks: Scotiabank, National Bank, Bank of Montreal, CIBC. Canaccord is a smaller house that also covers it. The only one who has produced a re-rating of this nature and is coming with this is CIBC today. No, so I mean, certainly the analyst has the right and to publish whatever he wants and the right to stand behind his notes, and I do respect that. But I also have the right to my opinions.
Absolutely. And perhaps we can get him a subscription to the Mining Stock Journal for Christmas, and that might help with some of those details. But in all seriousness, I have 2 questions left. One is market related. We'll save that for last. But I'm going to pull up the note about the exploration budget, which came in at 49 million in 2024 and scheduled for 51 million in 2025. And obviously, I know that's something that not only is important to you, but I think is one of the parts you really enjoy, and just anything you'd like to touch on with the exploration program today.
I go back to my four priorities: balance sheet, investing in the portfolio. So you've seen we have in 2024 put $49 million to work to unlock value in the portfolio. And for 2025, we're budgeting 51 million, and we're seeking for opportunities to even expand that further, right? For example, success at Tongon, or a new discovery in the Seguela camp, or continued success with our work at Diamba will expand that budget for sure. So we're putting our money where our mouth is, right? We're investing heavily. We believe there is a lot of value to be unlocked in the asset portfolio, and we're working at it, right? We're putting the money. We have over 200,000 meters of drilling with budgeted across the asset portfolio and the two jurisdictions we work in, right?
Okay, and then the last one here. I'd love to get both of your opinions on what we've seen so far from the earnings from the producers, which I think a lot of people at home are hoping is this the quarter where we finally see strong numbers that begin to bring more investment money in, which obviously has been a little bit scarce the last couple of years. Although before we get to that, I'll just mention that here, you say we realize 7% higher gold prices, expanding operating cash flow margin from 33 to 50%. So I think that's one of the things that gets a lot of people into the mining space. And Jorge, you talked about this briefly before when we started, but here's our third quarter, or fourth quarter rather, and you can see that so far we're on track for a good average realized gold price in the first quarter. So that's what I think people hope for. And again, back to the question, any thoughts on what you've seen from the earnings and the reaction to the earnings as well as a sector?
Yes. In line what you were showing here, Chris, for the past 10 quarters, for the past 10 consecutive quarters, we have seen incrementally higher gold price each of those quarters, with the exception of only one. So over 10 quarters, consecutively higher prices, only with one exception, right? 10 quarters, that's 2 years and a half. So that trend continues, and the challenge for us as operators is to be able to keep a lead on cost so that higher price does its magic with our margins, right? And that's what we need to be laser focused on as management teams in the gold mining industry, right? So as long as we can continue to show that our margins expand, we're gonna be fine. And there is a lot of, I say, distraction in the market, I believe, right? With other asset classes and other sectors. The cryptocurrencies and Mr. Trump advocating for those cryptocurrencies to be part of the reserve or not, the Trump trade and the returns that generated, some of those being evaporated, like you see Tesla, artificial intelligence opportunities. I think there is a lot there, but quietly, I believe the gold and its role as a store of value for since humanity, 5,000 years of modern times, is there. And that's why I think we're seeing slowly but steadily gold playing its role as a store of value at moments of unprecedented uncertainty. And I think that's what we're seeing today. the type of uncertainty we're seeing today is probably not something that we have seen as in our generation, right? I think you probably need to go back, beyond some of us who were born in the 60s and
You got to go back to Dave's day and age there to really get that.
no, Dave is a spring chick. No.
Well, no,
Yeah.
Oh, I'm sorry. Continue, please.
Yeah. So I don't see in the market today a level of interest that corresponds to historic record price for gold.
Yeah.
I don't see it yet. I was just at one of the best conferences in the mining sector, which is the Bank of Montreal conference here in Florida. It took place a week ago, and yeah, I just don't see a level of investor interest or institutional investor interest that corresponds with the gold prices that we're seeing. Why? I believe that money is distracted, being allocated in all sorts of other classes until one day someone says, shit, I need something to risk, balance the risk in my portfolio. No? Yeah.
And that could well be if we continue to see volatility in the stock market. I know, at least on the retail level, what actually gets people picking up the phone and buying metal is when you have a big event, bank crashing, stock market crashing, Nikkei down 12%. And I don't know that we're in panic mode just yet, but interesting conditions with the gold price still elevated. So, Jorge, I appreciate everything you shared there, and you can let me know if there's anything else we did not cover that you would like to add.
Just something that is obvious. We enjoyed a very strong fourth quarter, and I said we realized a price of $2,660. That was the average price of gold at which we sold. Today, gold is at 2,900. That's what 7-8% higher what we did the previous quarter. So 7%, 8% higher consistently quarter after quarter, and that's what we're seeing. And so it's a good time to be in the business. I never seen in 20 years Fortuna as strong as it is today. Never. And yeah. And I think the team is doing an excellent work. And at times like this, the thing that we can do is buy our stocks back aggressively. No, that is what we're doing.
Well, and it's also nice to see the reaction to the stock today, where you are up 4.27%. And Dave, anything else that you would like to add or touch on today before we wrap up, my friend?
I mean, just to kind of add to what Jorge said about the earnings, I mean, my personal opinion is that the price of gold is going to continue rising for the foreseeable future. But also, you kind of have the best of both worlds right now, because oil is down 28% from its peak a little bit less than a year ago. So I can't speak to the rest of your cost structure, but that has to be, helping with the cost side of the equation.
Okay. Jorge, any comment on that, or?
Yeah, no. We already provided forecast for 2025, and what we're guiding is for cash cost and AISC to be flat to slightly lower than what we achieved in 2024. So once again, the relevance, the importance of being able to contain cost in this context of rising metal prices is what creates the opportunity, right?
Okay, and I'm just going to read one last comment that came in here before we finish up, because Thomas mentions, please, no dividend, put that money back in the company to find high-grade gold. Let's grow the resource. This will push the stock price high, not a few pennies as a dividend. So anyway, just want to pass along. And Thomas, thank you for that comment.
Every time I interact with investors, I ask them, what's your preference in terms of return to shareholders? And believe me, I get all sorts of opinions out there. The guys who say Warren Buffett never paid a dividend, to the guys that said I need the dividend, the other guys do the buybacks, you know. And we believe that what makes most sense to a company like us today in this market context where today is the share buyback. And I mean, looking at where even at 460 or whatever, we are very active in the market. Yeah.
Yep. And perhaps just before we wrap up, I would like to mention that if people do have questions, if you'd like to get in contact with the management at Fortuna, you can go to fortunamining.com. Just click on the contact tab. They have one of my favorite people in the mining space in their investor relations, Mr. Carlos Baca, who is going to be happy to help you, or need to get a question to Jorge or any comments as a shareholder. That is how you can do that. And then lastly, for the person who requested Dave at the Gold Pour. So Jorge, watch out when Yambasud is ready to go. He's going to be back. I hope someone has logged that bar into inventory and it still exists in outside of Golden, Colorado. But either case, congratulations on another successful quarter. It's really nice to follow that, seeing the things you've done in the last couple of years. So well done. And David, I appreciate you joining us here as always. And lastly, we'd just like to thank everybody at home watching. I hope you had some fun, learned some good things, and get to see what Fortuna is doing. And that said, we will